Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Got a great show lined up for you today. We're going to be talking about you don't always need to pick the hot technology stocks to get great returns. What are we talking about? We'll explain that in a minute here. Another week job report likely solidifies a Fed rate cut. We'll discuss that, what's going on with the Fed there and interest rates. Should you panic over the job opening data? It's kind of slipping. We'll talk about that. And I love this one too. American luxury brands are destroying Europe's luxury brands. We'll discuss what we're talking about there. Chase, what do you got?
Yeah, so companies we're going to take a closer look at today. Some big ones in the news this last week, but Kraft Heinz, obviously that has some ties to Warren Buffett, and now a split up that will be occurring. Also, we're going to take a closer look at Snowflake, Best Buy, and then Alphabet, which was again in the news in regards to its monopoly. So we'll break all that down, give you an idea if we think it's a buy, sell, or hold based off the fundamentals that we see here on air.
You know, Jason, just before getting into the topics here, when I was listening to the show opening, it says a fiduciary firm. You know, when I first started that, probably 15 years ago, we were one of the few people. We have more people coming now asking, are you a fiduciary? It's very important because it means a firm must do its best for you, not what is suitable. So I just thought I'd bring that up to people, what fiduciary means. If you're not dealing with fiduciary, you probably want to change. And make sure it's not one of the hybrid type, because you never know what hat they're wearing. But just a tip for people there. But let's talk about you don't always need to pick the hot technology stocks to get those great returns. What are you talking about, Brent? Because, gosh, they've done very well over the years. Well, investing is very emotional, and it's always nice to be part of the crowd and go to a party like, yes, I got Apple. Yes, I got Alphabet. I got Amazon. Oh, it's so fun to brag about that. But they are not always the top performers. Sometimes you're boring, undervalued companies can do very well.
Yeah, I mean, let's just take a look at an example here. I mean, everybody loves to talk about Apple, and Apple's been a little bit sluggish. Year to date, I still think actually they are still negative, I believe.
I think they're high 250 or 255.
260-ish,
260, yeah.
Yeah, but I mean, over the years, I don't want to discount that they done well, but if you look over the last 5 years, the gain was 114%. Again, not a bad return, but this, I think, would surprise people. If you look at a boring company like Tractor Supply, let's say, over the same 5 years, Tractor Supply was actually up 119%. If you look at an old insurance company, you know, Allstate Insurance, we all say, gosh, that's a big, dumb, boring company, right? Property and casualty insurance, that's not very exciting. Well, get this. They were up 115%, so they also topped Apple's return. And then lastly, I mean, this one I think will blow people away, but if you were able to find value in a company called Tapestry, which owns Coach and Kate Spade, funny enough, we'll talk about them a little bit more down the road here.
Yes.
But your 5-year return on that company, 545%. I'll tell you, their balance sheet looked very good 5 years ago, and everybody's panicking over the COVID situation. That was the time to be buying some strong retailers. Like,
and you know, it's funny, during that time frame, that was during COVID, a lot of people like, oh, they were all getting into buying the actual purses of Louis Vuittons and everything else. And it's just like, had you bought the stock, you're doing far, far better than buying the purses. But Apple's not only a big tech company that was surpassed by these boring companies. If you look at even Amazon, this one surprised me. Over the last 5 years, their return only 49%. I thought for sure they did far better than that, but only 49% for Amazon in the last 5 years.
And I'm not sure. I don't have. We'll look at Alphabet later in the show here, but I almost am wondering if Amazon is the worst performer of the big tech companies over the last 5 years, because 49% is pretty lackluster.
Yeah, I mean, I know Tesla did better.
Yeah, I'm pretty sure Microsoft has done better. I think they might be the worst performer in the Mag 7 there.
Yeah.
But one other thing, too, that many times people forget about is when you're looking at these boring companies, a lot of them pay dividends and they generate cash flow that can be used to purchase other equities on sale. And you might hear, yeah, Apple pays a dividend. You're right. They do pay out billions of dollars for that dividend because the stock and the company is worth trillions of dollars. That dividend yield, I'm going to say, is minuscule. 0.45%. So, I mean, if you look at the return that you got on dividends, I'm going to look at Allstate and Tapestry. I'm not sure what Tractor Supply has as a dividend, but you far exceeded the dividend payments and dividend returns on those stocks over an Apple where you got 0.45% on the yield now. So dividends are a great part to the total return. And those price appreciation numbers, those didn't include the dividend returns either.
And also, too, when you're talking about how Apple's 5-year gain was 114%, Allstate only 115%, people say, well, what's a big deal? It's only 1%. It's those dividends. I'm very confident that over the last 5 years, Allstate has increased that dividend. I think they've yielded around 3%. So you've probably gotten, I'll say, maybe 15 to 20% more. And then you get the reinvestment, not into Allstate, but get to use that money to reinvest. That's one thing Warren Buffett likes, is to reinvest. Get that cash flow so you have more money to reinvest. You didn't get that with Apple, but you did get it with, I'm pretty sure Tractor Supply does pay a dividend, so does Allstate.
You got it with Apple, just to a much, much smaller degree.
Oh, yeah. I mean, 0.45% is not a very good dividend. And, it is kind of funny. It used to be much higher, and I don't think they've ever increased it.
They have increased it.
Oh,
they just steadily increase it, but the stock has gone up so much over, I'm going to say, the last 10 years that dividend yield is just, it's laughable. I mean, it's so small, but I mean, that's what happens when you're a stock that trades at 31 times earnings. If you're trading at that high of a multiple, you're not going to have a good dividend yield because, dividend yield is going to be a function of the price of the stock. And, it just, I think, shows again how expensive Apple is.
Yeah, 31 times earnings. That kind of says it all. Let's talk about another weak job market that will likely solidify a Fed rate cut. August non-farm payrolls increased by just 22,000, which was well below the estimate of 75,000. That's about a third. It's a very bad report. This weak report also comes with another month of negative revisions, as employment in June and July combined is 21,000 lower than previously reported. They keep revising down on these numbers.
Yeah, and I'm just going to say, if you take 22,000 minus 21,000, I mean, really today there was like 1,000 jobs created because you had the two negative revisions. I mean, not very good. And then, I mean, you look at the top performers with healthcare and social assistance, they continue to lift the headline number as those sectors added 31,000 and 16,000 jobs respectively. I'm going to do some quick math here. That's about 47,000. So if you didn't have that, you'd be looking about negative 25,000 in terms of the payrolls. I mean, that's a problem. And many other areas in the report actually saw declines, with payrolls in construction falling 7,000, manufacturing declining 12,000, and then professional and business services dropping 17,000.
The personal and business services dropping, that one surprised me. Now, it could be mortgages. People aren't selling mortgages, but I'm kind of surprised. That's a big
But I'd push back on that, because if you look at mortgage demand, year over year, mortgage demand is actually up pretty substantially. There's more refinances. They have the weekly mortgage report. There is more production of mortgages now. So, I don't think it's the same way that mortgages got hit, a couple of years ago when rates really shot up and now nobody was refinancing. Refinances year over year, last I saw in the weekly report, are actually up.
I guess the refinancings, which is surprising to me, because who's refinancing out these rates? Because when it got to 3-4%.
People that bought at 8, 7. So, I mean, there is a pool of people that can refi.
I guess I'm thinking about the real estate people that are really having a hard time right now.
So, I guess they're having a hard time compared to 2021, 2022, but things have gotten maybe it's relatively better.
Yeah, maybe it's normal now that it feels bad.
I'll leave it there.
Let's talk about the government, because they also saw a decline of 16,000 jobs, and I worry this is a ticking time bomb, since employees on paid leave or receiving that ongoing severance pay are counted as employed in the establishment survey, and those that opted to take the government's offer at the beginning of the year, well, they'll start coming off severance pay as a deal lasted through September. The most recent data, and this is probably pretty close, I saw that said that 75,000 federal employees took the offer, but not all were accepted into the program. But this is a major number, because that could be 75,000 jobs gone.
Yeah, and I think it's, because I saw some people were like, and I got this from NPR actually, which people say it's unbiased. I think it definitely leans left. But regardless of that statement, NPR had said 75,000 initially came in, and then they kind of were reneged on that offer, and they were upset because the federal government didn't accept all 75,000. So, I mean, even let's say it's 40,000. So government was a decline of 16,000. Let's say it continues on that trajectory. I mean, you could see next month or the following month, all of a sudden government declines by 50,000 jobs potentially. I'll be very curious to see what that looks like. And that could push payrolls negative if government is that weak.
Yeah, next month in October, it's going to be a scary report.
Yeah, potentially. I mean, we'll see. I mean, hopefully there is some maybe pickup in the private sector, but we'll kind of discuss that further. I will say that the leisure and hospitality was a surprise to me, considering there was kind of weakness everywhere else. But that group actually produced a gain of 28,000 jobs in the month. And while much of this sounds concerning, I got to say the unemployment rate held relatively steady at 4.3%. And that doesn't incorporate the fact, I love to always look at this number, that 1.9 million or 25.7% of all unemployed people were jobless for 27 weeks or more. My belief is that many of those that have been unemployed that long, I mean, 27 weeks, you're now talking, what is it, 2.5 years-ish that you'd be unemployed? Oh, I'm sorry, not 27 weeks.
About 6 months.
About 6 months.
Yeah.
Not 27 months.
Right.
But again, 6 months, let's say. If you've been unemployed for 6 months, I can't imagine you've been looking for a job that hard.
And there's some people just don't really want a job. Like, yeah, if one great one came along, I would take it. But yeah, if you're not working for 27 weeks in this market, this job market, you really didn't want to work.
Well, maybe not this most recent one, but 5 months ago, it was pretty easy to find a job.
Yeah, yeah. I mean, well, again, we're going to talk about this in a minute about the labor turnover survey, but I just want to comment too with the unemployment rate low and deportations potentially weighing on the supply of workers. We just don't see how it would be possible to maintain a strong job market given the limited supply of workers. They're just not there. I know we're going to talk about the JOLTS report coming up next, but it's just the supply of workers is not there.
Yeah, I mean, the supply is not there, and I kind of want to go back to this point real quick about 25% of all unemployed that long term. I mean, again, having a 4% unemployment rate, just very simply, you take 25% of the 4%. I mean, that's essentially 1%. So you're almost looking at
I'm going to repeat that again. 25 to 24 of the one.
25%, let's say, of the 4%, essentially.
Yeah.
I mean, that could push the unemployment rate if you kind of pulled out some of those people that are long term underemployed. I mean, you might be looking at an unemployment rate closer to 3%.
Yeah.
So I think that just shows how strong the labor market has been. But I mean, kind of jumping into your point now about job openings, we saw the job openings and labor turnover survey, and this was, again, another potentially negative headline depending how you view it, but it fell to 7.18 million, and this looks back 2 months, so this was in the month of July. That came in below the estimate of 7.4 million and marked the lowest reading since September 2024. It was only the second time since the end of 2020 that job openings came in below that 7.2 million number.
Yeah, and again, 2024. If I look back to September 2024, things were kind of doing okay. So I mean, we're just pointing out the direction things could be going. We're not saying hit the panic button because that's not happening. And if you look at job openings before 2020, well, nearly 7.2 million openings would have been a great number. In 2016, job openings averaged 5.86 million jobs. 2017 averaged 6.12 million jobs. 2018, job openings averaged 7.11 million. And then 2019, job openings averaged 7.15. So we always say a number means nothing at all unless it's something to compare it to. The job openings of 7.18 million that came out for July is not bad, but it is a slowdown of what we had before. And there's jobs out there. Maybe as we talking, we can't find somebody to fill those jobs.
Yeah, and I mean, again, I want to reiterate the 7.18 million, that would have been above average in every single one of the years we just discussed. So 2016 to 2019, the average was below 7.18 million in every single one of those years. So that would have been an above average job openings report when you look at it that way. I think it really just shows how crazy the job market got post-COVID.
Yeah. And I've talked, I think there are people out there that they don't want to take anything less but the perfect job, perfect environment, 3 days working from home. I mean, there's things that they want. And that, by the way, that working at home, I keep reading more and more that is getting slowly dissipating to where it's not going to be around at all.
Yeah, and I just worry, I mean, this post-COVID situation, we just got so accustomed to things that aren't normal. I mean, you got accustomed to stocks surging 15% a year. You got accustomed to real estate surging at levels that are crazy. You got accustomed to payrolls growing at 200,000 a month. You got accustomed to an unemployment rate that's around 4%. You got accustomed to job openings that were around 9-10 million. I mean, that is not how the economy is going to function long term. And we've gotten addicted to mortgage rates at 3%. That's just not going to happen. And I think we become so unrealistic with a lot of things. I mean, it just kind of hits the point that, a lot of this bringing it back to reality, I'm going to call it, with job openings and, the payroll data, I'm just not overly concerned about it. I mean, job openings, I think you could see fall back to like a 6 million range. Yeah. And I think we'd still be in an okay spot from a labor market perspective. But even with that lack of concern that I think we have in the job market and the economy as a whole, I just think we're going to see a Fed rate cut this month. I mean, the market now essentially has a 25 basis point cut priced in at 100%. Yeah. And now they also have a 50 basis point cut on the table, with markets putting it at about a 12% chance. So again, still super low. I don't think that's going to happen, but that is up from 0% on Thursday before the jobs report came out.
Yeah, and I do want to remind people there's one more inflation report coming out. I think it comes out on Wednesday, the CPI. I think it's Wednesday it comes out. That, I don't expect it to be high, but if that comes in high, that could change the whole ballgame. Because remember the CPE?
The PCE?
PCE, that came in kind of not favorable. It was a little bit high. Not anywhere near the 2% they want to get to. That's what I'm talking about. It was like 2.8, 2.9, I think it was.
It came in right along expectations. The PCE, I don't hate PCE because obviously that's what the Fed looks at.
Right.
But PCE is almost guaranteed, as close to guaranteed as you're going to get in a lot of these data points, to what the estimates are, because you're already going to have all of CPI and PPI, which flows through to PCE. So a lot of times PCE doesn't surprise because you already have that. CPI could, though, because we don't have that data point yet.
And I don't think it's going to be bad because I don't see much inflation. But if it comes in bad, that's going to put Powell on the fence because he's supposed to be this one that is really against inflation, which is a good thing. You don't want inflation. Could he change his mind saying, gee, CPI came in at 3.1%. I can't reduce rates. That's too far off my mark of 2% that he wants from inflation.
You can distort numbers however you want. So I am of the viewpoint that they will be cutting rates in September in a couple of weeks. I don't necessarily think it's the right thing to do, but I just don't see how they will not, given how weak this jobs report was.
Yeah, and I do think that a lot of pressure to reduce rates, but I don't. And why would Powell? It's like you're leaving in February anyways. It's like, no, I'm going to do the right thing. Yeah. So, but
well, he's only one guy. He's still got to rally the other votes, and we know now that Bowman, Waller, they're going to vote one way. There's the new Fed governor. I don't think he'll be voting obviously at that meeting because I don't think he's been confirmed yet. But the other one left, so I don't know if Powell would have the votes.
Well, let's talk about that because we did hear from Fed Governor Christopher Waller, who is supposedly on the short list to replace Powell as Fed chair. He believes that should be a multiple cuts over the next few months, saying interest rates today are perhaps 1 to 1.5% points above the neutral level. Now, I want to talk about this because he's on the short list. Do you think if he said, no, I don't think rates should be cut, he'd be off that list so quick? Oh, yeah. I mean, are people kind of bowing down to Trump to get elected? I mean, is it the right thing? And it depends. Because we don't want runaway inflation, and that's the problem.
Yeah, I mean, it is a concern, and I think long term, I think rates are too high, but that doesn't mean long term is a year from now. I think rates could stay elevated, but 5-10 years from now, I don't think rates necessarily need to be this high. Right. I think it's like I don't understand the point of maybe pressuring lower just to appease the market, and I do worry if we do go forward with 1 to 1.5% in terms of the cuts that we would see. I think you're just going to fuel this bubble higher, and it's just going to kind of kick the can down the road, and maybe 2027 you just have a huge blow up. I don't know.
And for years I'd like the economist from J.P. Morgan Chase, David Kelly, and he kind of said that this does help the market, but it's not really the right thing to do for the economy, and he's kind of worried about it. So he's always been a very calm speaker. I've listened to him, I think probably 20 years, and he always has common sense approach. And I think if there's not a big CPI, we could see a half point cut, which I'm not sure it's the right thing or not. But we'll see.
I'd be very surprised at half a point. I'd be shocked at no cut. And I mean, obviously the most likely outcome is we're going to see a 25 basis point cut.
Yeah.
I think it's on the 15th, so
Yeah.
we'll probably still talk about this next week.
Yeah, we'll see what the CPI did, but we'll talk more next week on that. Let's talk about the American luxury brands are destroying Europe's luxury brands, because it appears that European luxury brands like Gucci, Hermes, is that what you say that,
I think
Hermes?
it's Hermes.
Hermes? Oh, okay,
I think it's
Hermes.
French.
I gotta say Hermes. Okay.
I'm guessing too.
Okay. This one's easy. LVMH have increased their prices beyond what the average consumer is willing to pay. Currently, American consumers are spending the lowest share of discretionary income on luxury goods since 2019. That's 6 years ago. The European luxury brands seem to have their heads in the cloud, thinking American consumers would pay any price for luxury purses from Europe. I think they have now discovered that American consumer has, well, surpassed their limit.
Yeah, and I mean, this has been a benefit to I'm going to say, two luxury American brands, and it's kind of funny. They're luxury, but not as luxury as the Hermes of the world. And as you can tell, I don't shop there, so I don't know how to pronounce it.
I don't shop there either.
But again, these companies have benefited from the ignorance of the European luxury brands. And the companies I'm talking about is Ralph Lauren and, again, Tapestry. We talked about the great returns that you've received from a company like Tapestry over the last 5 years. Big reason for that is they've seen their sales increase at the cost of potentially these European companies. And then the stocks have definitely outperformed those European brands as well.
And one may be thinking now is the time to step in and buy Tapestry or Ralph Lauren, but with the recent stock increases, they're no longer great value. I mean, Ralph Lauren trades at over 20 times forward earnings. Tapestry now over 19 times earnings. You would have had to foresee this probably 2 to 3 years ago when everybody's all hot on the European brands, down American brands. That's when you buy companies when they're on sale. These are no longer on sale. I would not recommend to buy Tapestry or Ralph Lauren.
Well, and I remember looking at Tapestry years ago and kind of looking at the spread between the margins that the European makers were getting. And actually the CEO said that. They're like, well, we haven't seen a spread between European luxury and American luxury this high. So they think there was an ability to close that gap. That's exactly what happened. But now I want to take the different side of the coin, as I believe that European luxury brands will likely not just sit on their hands and do nothing. They're likely going to try and win back market share. So with the increase in prices over the years, I'm sure that their profit margins are just huge. They're definitely very fat. And that could then leave a good amount of space to do some heavy discounting to get that market share back. So again, that'd be narrowing the difference between what you're paying for a Coach bag and, again, a Louis Vuitton bag. And Louis Vuitton, again, I don't know fashion that well, but I know that has a better name than Coach still.
Yeah.
So you pay less for a Coach than a Louis, but again, that could narrow to try and attract that kind of mid to high level consumer.
Yeah, the European luxury brands said, "Oh, we're not going to lower prices." Yeah, they will if they lose
might.
market share.
Yeah,
I think they will. So, and then on a side note, in years past, we have warned people about paying the high prices for these European purses that they would not appreciate, if at all. I have not researched it, but I feel pretty confident in saying if sales are down as much as they are, the resale on those expensive purses you bought a few years ago, that's probably dropped as well. You probably can't even get what you paid for those, I'd imagine. And I know there's always some one collectible out of 20 of them or whatever, but overall, people just buying those like, oh, these are expensive, they're going to go up. I don't think that happened.
And I just want to say one piece of information before we jump into the stocks, but I saw this today, and I'm curious if it'll hold, but looking at September is historically the worst month for equities, so we'll see. The S&P 500 has averaged a 4.2% drop over the last 5 years and has fallen more than 2% on average over the last 10 years, so we'll see if this will be a difficult September or not.
We will see. Let's talk about one of our companies here, Kraft Heinz, KHC, in the packaged foods industry. They're in the news a lot lately. Chase will talk more about that, but let's look at the numbers. Short on the float is about 6%. Institutional owned 59.4%. I believe Warren Buffett, Chase will talk more about this, does own about 27% of the stock. Kraft Heinz, price earnings, nothing there. They have no earnings over the last 12 months. Industry at 16.3. Price of sales 1.3 versus 0.4. Price to book value 0.8 versus 1.9. And then price of cash flow is expensive for Kraft Heinz 7.5 versus 3.7. The peg ratio going forward, terrible. 142 versus 123. Usually we like these around 2 or 3, not 142. We do see in the earnings, no growth on the earnings over the last year, even 5 years. Sales for last year down 3.8%. The industry was actually up 30.1%. The 5-year estimated growth from the analyst, only 0.1%. Industry 2%. Kraft Heinz does pay a nice dividend of 5.9%, but no payout ratio because they have no earnings. It does take 55% of their free cash flow to pay that dividend out. We do see on the balance sheet, current ratio 1.1 versus 1.5. That's okay. Debt is in check, 0.5 versus 0.8. Net profit margin, this is terrible, a negative 20.8% versus a positive 5.2 for the industry. And then return on equity, a negative 12.7 versus 12. Their free cash flow is actually pretty good, though, $3.5 billion, about double the industry at $1.4 billion. Chase, what do you got?
Yeah, so current price here for Kraft Heinz, again, their ticker symbol is KHC. It's $27.29. The 52-week range, the low here is $25.44 and the high $36.31. I mean, the 10-year return on this is just atrocious. It's down 63.5%. I was going to see what it was with dividends.
It was down 41.3.
I mean, it helped cut off about 20-ish% of that. So the reason that's important is about 10 years ago is when Warren Buffett and then a private equity group, 3G Capital, had the idea to merge these two companies, Kraft and Heinz, together. And obviously that was not a great idea as it has not performed well. But now the big news is they are splitting these companies once again, and they're not really divulging what the names of those companies are going to be. As one company will hold Heinz Philadelphia and Kraft Mac and Cheese. That's about 75% of the sales came from sauces, spreads, and seasonings. And then the other business is going to be kind of more of a scaled portfolio of North American staples, which would include items such as Oscar Mayer, Kraft Singles, and Lunchables. I would assume that maybe the sauces company would get a higher multiple than the staple business. Yeah. So we'll have to see what happens here. But I know Buffett was not a fan of this announcement.
You know, and it shows what a long-term investor he is. He's down, we figured it's more than I thought it was, 10-year return down a negative 41%. But he still thinks it should continue on. I'm not sure why, but he likes the business. He likes the idea of the business. But he is against that split up. And I read some things, too, that it is not always the best thing to do for companies. It doesn't always pan out.
It doesn't always pan out to merge or to split off.
Spin off.
Yeah.
Split. Yeah.
I mean, we'll see. I mean, because the value is still here. I mean, the company has a great forward PE go out to December 2026. Estimated earnings per share, $2.67. Estimated sell would be $44.32. And the interesting thing is, again, the value's there. But generally, when you announce that split, you get a bump. Yeah. In this case, the stock fell. I think it was like 7%.
Yeah, it did.
Because I think of Buffett's discomfort with it.
Yeah.
But the concern is, what if he starts selling shares, owning 27%? That could cause the stock to fall dramatically.
I don't think he'll do that. But all right, we're going to take a break. When we come back, we've got Harrison Johnson, our financial planner, coming up. Talk about mortgage rates reached 2025 lows. Stay with us. We'll be right back. Alrighty, welcome back to the second half of the Smart Investing Show. I didn't get to promote the newsletter. I want to do that because a lot of great information on there. On that newsletter, we talk about, you always get to pick the hot technology stocks. We talked about that already. But also, too, would you fly in an airline that filed bankruptcy twice in 1 year? There's one that did that. Water shortages around the globe sound scary. Could it reduce meat and dairy production? And then also in there, Harris is going to bring more information on this, but mortgage rates reach a low in 2025. So a free newsletter goes out every Friday by email. Go to smartinvesting2000.com. Again, that's smartinvesting2000.com. Harrison, let's talk about mortgage rates hit a new low in 2025. What does that mean for us?
They did. So as of Friday, they've reached the lowest point this year for 2025, and it's the lowest point since last October. So all of 2025 so far, 30-year mortgage rates have hovered between 6.5% to 7% for primary borrowers. And as of Friday, they touched 6.29. So a little bit of a decline. A lot of that is because of the employment numbers that came out on Friday, and now with the pretty much guaranteed expectation that cuts are going to be made from the Fed in September. So there might be a little bit of a window here for buyers, but especially people who have mortgages to look at taking advantage of this and be able to refinance.
And before you come on, I don't know if Chase will talk on air or off air about the mortgage brokers not being busy, but you talked about the refi a lot, which I'm kind of surprised on. And one thing that still worries me, I mean, the Fed cuts short-term rates, and I think right now there's just in sympathy that rates are falling the long end. But when we start, and again, once a budget come up or the debt ceiling, I think it's October.
It's coming. It's soon.
It's soon.
Yeah.
I think that's going to be a problem for the 10-year Treasury because it's going to come out like, well, we need more money. We need more money. And that pushes up the long end. So there may be a small window of opportunity to refinance there.
Definitely, because rates don't just consistently go down, in a straight line. When you look at last year in 2024, there were 3 rate cuts: September, November, and December from the Fed. But the lowest mortgage point was early October, right after the first cut. So even though the Fed cut rates 2 more times throughout the end of the year, mortgage rates started to increase. So there's not a direct relationship between what the Fed does and mortgage rates. So this really might be a window. We'll see what the Fed does the rest of the year. We'll see what happens with the budget, but also this might be a window. I don't think that we're at a low point over the next several years. So I don't think we're at a point where it makes sense to pay points or pay extra to buy down the rate. But if you have a mortgage right now that's in the mid to high 6s to 7 or above, this might be something you want to take advantage of.
And I was going to say too, one thing that kind of gets forgotten about is, we talk about the 10-year. I don't think the Fed would go ahead and do this. We talked a lot about them cutting rates, but, re-implementing quantitative easing.
Right.
That would be, I think, foolish in my mind, because what that is essentially, that's the Fed now stepping in and buying more treasuries, buying more mortgage-backed securities, and that in theory is going to create demand for those issuances, which would then in theory push rates lower. I don't think they need to do that at this point, and I think that would cause longer-term problems, but just again, that could be something if they start announcing quantitative easing to help push rates lower. It's something that's maybe on the table with this push for a softer Fed.
That's part of the reason why also, like in 2020 and 2021, why mortgage rates got so low. The Fed was aggressively buying mortgage-backed securities and mortgages, and they had all the demand. And so, you saw 2% interest rates on 30-year mortgages. So that was such an unusual time. We're not going to get back to that. But now, being in the low 6% range is a pretty good place to be, short term. I think, next year, the year after, there's probably going to be more opportunities to refinance into lower rates. But this is something that probably borrowers want to take advantage of.
And, Chase, you brought up the Fed. One thing I'm not seeing in a while, I think they're still letting the bonds fall off the balance sheet. Last time I knew, it went from like $9 trillion, I think, down to $6 trillion. I don't know where it is now. I don't hear about that any longer. But that's a thing as well that's kind of helpful where the Fed stands. And we should look into that if you're not doing that right now, I think.
Let's see. It says, this is from 2023.
Yeah.
Let's see. I don't have it off the top of my head.
Well, we should look into that. Just because I think it could be around $5 trillion, which would be, it could be good, but then you're right. They might say, oh, well, let's start easing again and raise that debt up, which we don't want them to do.
So anyway, rates at a good point right now. They've kind of consistently been coming down, but if you're someone who's been on the fence about looking at trying to refinance, if you've gotten a loan, whether you bought a house or you refinanced within the last 2 years, this might be a good time to see if you can drop that rate a little bit more.
And I just want to reemphasize too what you said too is don't pay points.
Don't pay points. Don't pay points, because for the last several years, whenever I've looked at the break even when it's worth paying points, it only makes sense to do that if you're going to have that specific mortgage for 4-ish years or so.
Right.
3 to 5 years is the window. So what that means is if you think you're going to have the opportunity to refinance into a lower rate sometime in the next 4 years, which I think that is likely, you don't want to pay points. So try to refinance, get a lower rate than what you currently have, but don't pay extra to get that lower rate. Even if that means, because mortgage brokers always like to say that, well, I can get you into the 5s. Well, you're paying for that. Don't pay for that. Sometimes it's better to take the higher rate, don't pay any points, and then just look at refinancing again in another year or two or whatever it is.
Is there a rule of thumb on when to refinance, how much rates have to drop before you?
The rule of thumb is like 0.5% or 75 basis points of a cut, but I don't look at it that way, because the way I look at it is I've refinanced my own personal mortgage like 4 times, and every time I do it, I only reduce it by like 1/4 of a point or even 1/8 of a point. But when I do that it doesn't cost me anything. So it
Right.
costs me nothing to originate that new loan, and I'm dropping the rate. So that makes sense. Now, it doesn't make sense if I was, paying $10,000 to drop it 1/8%. So you have to look at what is the rate declining, but also what is the cost that it takes to get that lower rate. So don't pay extra to get that lower rate. There's probably going to be more time in the future to get that lower.
Yeah.
Just to drive home this point on the Fed, I was kind of looking up while you guys were chatting there.
And
but
I can see you over there working. I can see.
So currently the balance sheet is about 6.6 trillion.
Ooh.
It did near about 9 trillion. But what happened, and this is amazing to me, this didn't make big news, is the treasuries had a roll off of, I think it was like 35 billion. That slowed down to 5 billion a month. So that has really cut the pace of how much that balance sheet was shrinking. Actually, it went from 25 billion to 5 billion as a monthly cap on the treasuries. And then this is interesting. Mortgage-backed securities remain steady at a $35 billion limit. So that might be one reason why we've seen such a wide difference between the 10-year treasury and mortgages is because they've allowed treasuries to run off now less than mortgage-backed securities.
And
And again, this didn't make big news. This is way more important than a Fed rate cut in
It's
my mind.
important, but that is probably harder to understand than the Fed is cutting rates. I mean, you can wrap your mind around that, but letting runoff happens of different types of debt is a little bit difficult for people to kind of
And I was surprised on the slowdown of runoff. That's what, because I thought it'd be like 5 trillion. 'Cause they had a pretty big pace of a runoff, and you said it's only 5 billion.
Yeah, so I mean, I guess in theory, it'd still be in about 40 billion if they were hitting the monthly cap every month. But before it was 25 plus 35. Yes, I mean you were at
about 60, 70.
70 billion.
Yeah,
Yeah,
you could do almost $1 trillion a year.
Yeah.
So, but that's slowed down. And that's why they're not talking about it.
Yeah.
Well, Harrison, thank you very much for joining us. Great information on refinancing. And again, do not pay points.
don't pay points. Yeah, no.
Thank you very much. Again, that's Harrison Johnson. He is our financial planner. He is a CFP. If you want a free consultation with him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Send an email. You get a free consultation. And again, he's a fee-based planner. He's not going to try to sell you annuities or life insurance. Compare what you have now to what he does. You'll be very surprised. All right. Chase, I forgot our phone number also. I'm like, gosh,
it came to you.
It came to me. So, all right, let's talk about the next company, Best Buy. And I don't go in this company a lot, but I always like it when I go in there. I feel like I'm kind of techie, even though I'm not.
I think we'll be going there pretty soon. We need a couple new computers for the office.
I know it. I love computer updates. Let's talk about Best Buy. They're in the specialty retail. I'm surprised on this. A short on the float is 8.8%, and we get kind of nervous at 10. We do see that the PE ratio it's high. It's 21 versus 23 for the industry. Price of sales 0.4 versus 0.7. That's good. Price to book value 5.9 versus 3.6. Price to cash flow 7.9 versus 9.1. And then PEG ratio does look good, 1.2. Nothing for the industry. Now, the earnings, unfortunately, over the last year are down 29.2%. Industry was up 7.7%, and that could be from accounting. That's why you got to look at the financial statements to really understand what these are telling you here. Sales were down 2.6%. That's better than the industry because the industry was down 10%. And the 5-year earnings per share growth estimate from the analysts, they're looking for 9.1% for Best Buy, but a decline of 3.2% for the industry. Oh, they pay a nice dividend, 5% dividend. They do have to use 92% of the earnings to pay that out, only 60% of the free cash flow to pay that out, so that's not too bad. We do see on the balance sheet, current ratio 1 versus 1.6, that's okay. Debt to equity a little bit high, 1.5 versus 1.4. We do see a net profit margin of 2.1 versus 3.4. I'm kind of surprised that's so low, but return on equity is very good, 32% versus 20.1. And they do have free cash flow of $1.2 billion a year versus 1.3 for the industry. So things are kind of mixed here. What do you got, Chase?
Yeah, so I'm going to give the current price here for Best Buy. It's $76.17. It struggled so far this year. It's actually down about 11% considering a lot of other stocks, and the stock market as a whole is up about 10%.
Yeah.
Over the last 1 year, down about 23%. 5 years also struggled, down 27%. But they were doing really well in the run up to COVID. Their 10-year returns 102%. Again, even though they're down about 27% in the last 5 years. Looking at recent earnings report, this is kind of what prompted us to look at it. They fell about 6% after they stuck with annual sales and profit forecasts, even though their quarterly results topped estimates. So people get worried about that because it's like, well, you beat in the quarter, but you didn't lift the rest of the year. So now you're expecting maybe a slower back half of the year. Big reason for that appears to be tariffs. And I think that's having a pretty large weight potentially on Best Buy and the business that they operate. Going forward, though, for Best Buy, looks like they do report on a fiscal basis. So we are going to go out to January 2027. See estimated earnings per share here of $6.69. Gives you a target sale of $111.05. I mean, trades at a forward PE of about 11.5 times. I mean, it's a good, attractive value. Got a nice dividend. I kind of like it. And I have mixed feelings many times with like big box retail stores. But I think with technology, I'm not very techie. You're not very techie. I don't know what the heck is going on with a lot of this stuff. I don't feel comfortable buying technology on Amazon many times because I'm like, I don't know what a gigabyte is. I don't know what the speed processor is. So I think having that Geek Squad there, that separates them from even your Walmarts and Targets. And I think it really kind of is a competitive advantage potentially and could give them a lasting impact.
Yeah, and I did buy, I think, 9 months ago from them a theater setup. And I went there because they have people that help you. They have their Geek Squad, I think it's called. They came out, set everything up. I have not moved anything. It's like, hit this button, it'll work. So that's what I do. But they came out and they showed me that. And then if you had questions, give them a call. So that's very, very positive. And that's why they help people that are less geeky or less tech savvy than they are. And I did notice, it's surprising, 90 days ago, the earnings per share was $6.70. It's only $6.69. So no concern from the analysts about the tariffs. So I've always kind of liked this company, and I've watched it for years. It seems to go up 30-40%, then drop, up 30-40%. It seems to be when it hits these buy levels, it's a good buy.
Yeah, and I saw the CEO on CNBC this past week, and she was talking about,
it's a she?
Yeah, it's Corey Berry, I think is her name. And I liked what she had to say. She seemed very knowledgeable. Obviously, to be running a company, you got to be. But she was talking about the health tech, so kind of these Oura rings and the Apple Watches. And that's really been, I think, a big area of emphasis for them. And it makes sense. A lot of people are interested in the space. And again, a lot of people don't know much about it. So having an ability to go in there and ask somebody about it's helpful. And they also were saying they're testing different store formats. So like in, downtown Atlanta or I don't know if it was New York City, but that's one that comes to my mind. Like the Miami was the big one. They're testing these smaller formats because you can't buy real estate or rent real estate. I'm thinking of the Best Buy for our San Diegans in Mira Mesa. It's a huge footprint. Yeah. You don't want to have that in a downtown area. That's going to be way too costly. So we'll see how that test goes. And then they're also testing other areas. I think they opened a Best Buy in Bozeman, Montana. So
I think I heard that, Bozeman, Montana.
Yeah. So, I mean, it sounds like they're expanding. It sounds like maybe there is some room for growth that they do see. I mean, I'm interested. I think this is a very good possibility of a good opportunity here.
And remember that short on the float's about 9%, which is surprising. Although the shorts have to cover, like the stock could rebound quickly.
Yeah.
So, but I'm not sure why that's there. So, Best Buy, possible buy on Best Buy.
Yeah, I like it.
I kind of like it too. Are we going to add it to the portfolio, think, or we'll talk about that later?
Maybe the watch list. We'll see.
Yeah, we'll see. So, let's talk about a company that actually was a hot stock. Gosh, how long ago? It wasn't. I want to say a couple of years ago. I'm talking about Snowflake. Was it a couple of years ago that was a big?
It was kind of when they IPO'd. I'm trying to see if I can find the max chart. Yeah, so let's see. It was actually around 2020 is when they IPO'd. Looks like they did hit a max price, and this is just on the chart. But in 2021, when there's all the craziness, it looks like they hit around $400 a share.
Okay.
So 2021 is when the hype really set in.
Yeah, and I kept saying, like, why? What's going on here? And I knew it would cool down, which it has. So now we're kind of looking at this company is now Snowflake. I just don't like that name. But Snowflake, is it a company you should be buying? They are in the industry of software applications. Only 3.2% short on the float. Only 72% institutional owned, which is kind of surprising. Unfortunately, not a good start. The PE ratio, not material because I guess they still have no earnings after, you said, about 5 years. Industry is at 62.4. Price to sales are expensive, 18.3 versus 6.7. Price of book value, 31.8 versus 6.9. Price to cash flow, 90 versus 30.8. And the PEG ratio, 17.6 versus 8.6. So all these numbers you want lower, and they're just not lower. They're still not a good buy based on the valuations. No earnings over the last year, even in 5 years. Sales were up 19.8% over the last year versus 5.3, so that's a positive. They do get a 5-year growth rate from the analysts of 10.6, not much higher than the industry at 7.7. They do not pay a dividend. Look at the balance sheet. Current ratio 1.6 versus 1.7. That's okay. Debt to equity 1.1 versus 0.5. I'm okay with that. Net profit margin shows a negative 36.4. I mean, that's just ridiculous. They lose 36 cents on every dollar they bring in. That just doesn't make sense. And again, it's been around for about 5 years now. Return on equity a negative 58.1. Free cash flow is only $736 million versus about $3 billion for the industry. I'm still not liking this company unless you have something great going forward here, Chase.
Yeah, I mean, looking at the current price for again Snowflake, their ticker symbol easy SNOW, SNOW. It's $225.58, 52-week range. Done very well off 52-week low of $107.13. 52-week high, though, $249.99. And I did confirm it looks like that all-time high was $401.89. That's a closing all-time high, and that was hit November 16th, 2021. So you're down about 50-ish% if you would have bought it, the hype in the peak back then. Looking forward, though, I mean, gosh, yeah, not liking this. You go out to January 2027, estimated earnings per share $1.66, gives you a target sell. It's laughable, $27.56. The forward PE right now for Snowflake, 134 times.
So still one of these hot stocks that paying too much for, you have lost probably about 45% of your money since the high. I was kind of hoping that this would now be on sale, but it's not. And it's just sometimes that happens, and it's still a hot stock.
And I don't know what the heck they do. I went to ChatGPT and asked, what does Snowflake do? It says they provide data warehousing, data lakes, and data sharing services.
Data lakes?
Data lakes, Lakes.
What would that be?
I don't know.
We need a tech person on our show.
Yeah, but it looks like they have something to do with the cloud and, artificial intelligence. I think that's why they kind of got excited there in terms of the price spike. But, we may use this company and not even know it potentially in terms of transferring data and who they work with. But, that is one thing, obviously, any stock you buy, you want to understand what they do and who uses it. And, it required me a little bit of research to see who uses Snowflake.
Yeah. And also, too, you said it's kind of based on AI. And we have talked about this before. What if the AI expenditures slow down? Because companies are spending hundreds of billions of dollars on this. And what if they just cut back 20%? That's going to hurt companies, a lot of companies, including Snowflake. And again, I still don't know what data lakes are.
Yeah.
I mean, I'm thinking of a lake out there with data.
Yeah, beats me.
Probably the tech people are like, gosh,
these guys are idiots.
Yeah, they're idiots. Chase, they don't know anything about technology. Well, let's talk about, you want to do another tech company?
I was going to say, too, it's just, it's one thing that Warren Buffett stayed away from tech for many years because he didn't understand it.
Right.
And that is one thing that, I don't want to try and be the smartest guy in everything out there, and technology is not our strong suit.
Yeah, and it's not. And again, it is hard to understand. I mean, the iPhone, yeah, it's a phone. I mean, we did buy, AT&T years ago. I mean, we'll buy things that are kind of techy, but not tech companies like a Snowflake. It's just too hard to understand their product. I know we want to look at Alphabet.
Yeah.
And I know we talked prior to the show, was it GOOGL?
Yeah, we want to look at GOOGL, and Alphabet's a little confusing because they have GOOG and GOOGL. Yeah. Difference is GOOGL is the Class A share, so they come with voting rights, where GOOG is Class C share, no voting rights, but in theory, they're the same in terms of ownership of the cash flows, the earnings, the sales, and things of that nature. But I thought we'd look at GOOGL, the voting shares, because if we were to buy this company, we would buy the voting shares.
Yeah, and we highly recommend if you are going to buy companies, buy the voting shares. Don't buy the non-voting shares because you can really be left out in the cold with that. So
Learn that from personal experience.
yes. That's one thing I love. People say, "How, you've been doing this for over 40 years. Why do you still love doing it?" Because I'm still learning. I mean, things keep changing and learning. It never gets boring. Sometimes you're like, doggone, I wish I knew that, but it just keeps changing, so it keeps you into it. But talking about Google, again, the symbol is GOOGL, the Internet Content Information Industry, only 1% short on it, 81% institutional owned. PE ratio 25 versus 26.9. We do see price of sales 7.8. That is the same as the industry. Price to book value 8.6 versus 52. That's a positive. Price of cash flow 21.7 versus 21, and PEG ratio very good 2.6 versus 17.3. Now, over last year, their earnings, and I know you're going to talk more about the lawsuit, but hasn't slowed them down. Their earnings over last year were up 34.6%. The industry is up 38.9%, and sales climbed by 13.1% versus 14. The 5-year earnings per share growth estimate for the analyst 9.3 versus 6.6. Here's another one like Apple. They pay a dividend 0.4%. They use 8.6% of their earnings to pay that out. I'm not sure the reason why. Maybe there's put some somewhere else, but 0.4%. You would not be buying this company for the dividend. Taking a look at the balance sheet, current ratio good, 1.9 versus 2.1. Debt to equity, it's only 0.1 versus 0.2. Very low debt with Google. And you think of all the things they've done with Waymo and YouTube. I mean, they've done it just from cash flow, it appears. We do see the net profit margin is very good, 31.1 versus 30.3. Return on equity also good, 31.9 versus 32. Free cash flow. I know you're sitting down, but this number is amazing. $66.7 billion versus $48.6 billion. And we do know they are spending money on AI, but they still have a pretty high cash flow.
Yeah.
So it'd be higher if they weren't spending whatever it is on AI. But, I mean, you got to do some, so they can't not do it.
So let's take a look at Alphabet Google. I think most people call it. The ticker symbol here we're going to look at is GOOGL. Current price here for, again, Alphabet, $235. 52-week range here, $140.53 is the low. The high, $235.76. And I got to say, gosh, I was blown away by the return here on the last 5 years. I didn't think Alphabet had done this well. And we talked about the Mag 7 earlier, and I was like, maybe, Amazon wasn't the worst performing one. Alphabet up 208%, it looks like, over the last 5 years. Pretty crazy.
And, if you looked at that probably just, I don't say 6 months ago, it probably is nowhere near that. Because I think, didn't they get down like 140 in the price about 6 months ago?
What did I say? The 52-week low is 140.53. Nailed the nail on the head there.
Yeah. Wow.
But looking at the valuation for Alphabet here, we go out to December 2026. Estimated earnings per share is $10.62. I mean, that gives us a target sell here of $176.29. So forward PE now is expensive at 22 times earnings. Those future earnings, I should say. And I remember when it was at like 140, we talked about, gosh, if it falls a little bit further, maybe we could step in and buy it. But unfortunately, it looks like may have missed the boat there.
And did you say 1057 was your?
1062.
Okay, because I show over here on Stock Rover, they're showing 994.
Interesting.
So maybe.
Is that 2025?
That's 2025, 60 analyst.
Okay, I'm looking at 2026.
Oh, let me go one more time. Let me see here. Oh, I got to move to the right.
Yep.
Screen at 1058. Sorry about that.
Yeah. So yours is still 1058, mine's 1062. So,
yeah.
I mean, because mine's 994 for 2025. But, I mean, the big news that we got out here from Alphabet was this, antitrust deal, right? Yeah. They're a monopoly. And it came out that their remedy, so to speak, is they don't have to sell Chrome, which that was the worst case scenario for them potentially. But also, too, they can't sign exclusive partnerships and they have to share data. Now, that exclusive partnership is really referring to Apple at the end of the day. And Apple pays, Google pays Apple $20 billion a year to be that default search engine. And I don't get it. I don't know why they do it. I feel like even though that wasn't a requirement for them to, not do that anymore, I think they should not do that anymore and return that $20 billion potentially to the shareholders.
Or even cut it down as like, look, we're not going to give you $20 billion. We're going to give you $10 billion. I mean, they seem to be in the driver's seat. And again, they did that years ago.
Yeah.
I mean, I know on my phone I have the search for Apple, but then there's a Google button right next to it. You know? So I don't get why they're spending that $20 billion. Maybe we're missing something.
I mean, maybe we're missing something, but I think there's a better avenue than spending $20 billion. And I heard people say they should invest that money in AI instead.
Oh, there you go.
We'll see.
We'll see. Well, there's a closing bell. Thank you for listening to Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. And go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Got the newsletter there. Goes out every Friday at 5 o'clock. It's free. Sign up there. A lot of great information. The podcast is there as well for you. If you missed something. Again, thanks for listening on the Smart Investing Show. We're back next week. Have a great one.